Long-term care insurance is a topic that comes to the front of a lot of people's minds when they start thinking about their own retirement. For a lot of people, this starts to happen in your early 50s when you think you might have 10, 15, 20 years away until you start thinking about your own retirement. And some of the questions that pop up are, should I go out and get a policy myself? Does my workplace have a policy that I can opt into? Do I have enough money to pay for care if I need it? Who might care for me if I need it when I'm 80, 90 years old? What about an assisted living facility? Do I have the financials to support that? These are all questions that come up when we start putting together our own retirement plans. And in today's video, I'm going to go over the landscape for long-term care insurance today. I'm going to cover the situations when you should or should not pick up a long-term care insurance policy and go through two specific examples using our financial planning software. One example of a couple who should pick up a policy and another example of a couple who should not pick up a policy. So we're going to start today by talking about the landscape for long-term care insurance. Long-term care insurance is a relatively new thing. The reason being, we didn't need long-term care services 100, 200 years ago because everybody just lived with their families. When you got older, you moved in with your kids, families stayed closer together, and when you got to the age where you needed help with activities of daily living, like moving from a bed to a chair, dressing yourself, feeding yourself, holding continence, things like that, your family was there to help you. Now that's not really the case. We live farther apart. And most retirees, most people who need help with services are kind of on their own. Their kids are not there to help them all the time. So, about 30 years ago, the insurance companies got wise to this, and several life insurance companies came out with this product called long term care insurance, whereby you buy a policy, you give the insurance company money, and then if you happen to need services as you get older, that policy will pay you back money to go toward your payment for those services. So you pay into the policy, then you can make a claim later as you get older and may or may not need care. So what happened is these life insurance companies have been in business for a long time. They have a lot of data surrounding what are called lapse rates in life insurance products. A lapse rate is how many of the outstanding life insurance policies they had were renewed on a year-to-year basis or lapsed because people stopped paying premiums and the policies went away. And that was a very interesting thing because with life insurance, as your wealth grows, as you get older, typically your need for life insurance goes down. Because remember what the reason that you get life insurance is, it's to protect everybody else who's reliant on your income and your future earnings. For me, I have 3 kids at home. They're all under the age of 10. If I get hit by a bus, my family is going to be put out financially and will have to make very drastic changes. So guess what? We have a bunch of life insurance so that they can maintain their standard of living if something ever happens to me. But I'm expecting that as I get older and I put more money into the bank, more money into savings, more money into my own retirement, that if something happens to me, at some point, the money that we've saved up is going to be enough for them to maintain their lifestyle. We're not going to have a need for life insurance any longer. So the lapse rate for life insurance policies reflects that concept. As you get older, more and more people tend to let their life insurance policies go. And when life insurance companies started coming out with long-term care policies, this new product, they wrongly assumed that the lapse rates that they knew from life insurance policies would apply to this new long-term care policy product that they were coming out with. And this is where all the bad news, the bad headlines you might be familiar with, made their way into the media here 10, 20 years ago. The exact opposite actually happened. Because guess what? As you get older, your need for life insurance might go down, but your need for long-term care services actually goes up pretty dramatically. And the majority of us are going to need some kind of help in this regard as we get older. So the insurance companies are expecting more of these policies to just drop off because people don't need them. They were very wrong about that, and more policyholders made claims for benefits than they expected. And so the insurance companies are way underwater. And as a result of that, they were forced to increase premiums for other policyholders, or excuse me, all policyholders, really dramatically, and many times 50, 100% over several consecutive years, which is the worst case scenario. If you bought one of these things when you're 55, now you're 70, you've been paying into it for 15 years, knowing that you might need to draw on the policy to pay your benefits as you get older. And now all of a sudden it's doubled, tripled in cost. That's just the worst case scenario. So that's the landscape historically. Today, policies are starting to get a little bit better. We've not had dramatic premium increases as an industry, I'd say, over the last several years, which is by and large a good thing. There are a lot of variations on long-term care insurance in general. There are hybrid policies with life insurance. There are standalone long-term care policies. There are all shapes and sizes of this. The way that we think about this and the way that we determine whether it's a good idea to get insurance or not is that people fit into three buckets. On the one hand, if you're wealthy enough to where you can do all the things that you want financially, you can leave the money to your kids, to family, to charity, you can do all of the things that you want, even if you need long-term care services for a substantial period, and you can pay for those out of pocket without jeopardizing those objectives, then there's no reason for you to buy a policy. Because when you buy a policy, you're basically transferring risk to the insurance company by giving them a premium and having them subsidize some of the benefits if you ever need care. But guess what? There's a chance that you might not need care. So why pay the insurance company if you can afford it out of pocket? That's group number one. Group number two is at the other end of the spectrum. If you're in a position to where the cost of a long-term care insurance policy is the difference between being financially independent and not, then it probably doesn't make sense to obtain long-term care insurance in that situation either. Because if the premiums alone are unaffordable, then you should probably roll the dice and hope that you don't need it, or maybe rely on your local state's program and what's offered through Medicaid. That's probably a better alternative. It's the people in the middle who are better candidates for this. And again, on the first group, you have wealthy people who can self-insure. They can afford the costs out of pocket if they need them. It doesn't make sense to buy a policy. On the other end of the spectrum, group two, you have people who can't afford the policy in the first place. Well, don't go and pick it up then. It's the third group to where it makes sense, to where you can afford a policy, but you cannot afford the benefits out of pocket and still be able to maintain your lifestyle, do all the things that you want to do financially. So that's how we think about this. Now, there is an interesting twist on this that I'll add before we get into our specific examples for today's video. And that's that a lot of states are organizing around this concept because more and more people are getting to the age where they need help. More and more people are being forced to rely on their local state's program. And that's a big drag on state economies and really the US economy as a whole. So there are a number of blue states that are creating legislation right now to force you to pick up a policy or pay some form of additional state or local tax. And that might be something in the future that could change this dynamic a little bit. Today, it's not an issue, but that's the direction things might be going. So let's take a look at two different examples. One of a family, a couple who is a good candidate and should pick up long-term care insurance, and the second of a family, a couple who is not a good candidate for long-term care insurance. So here what we're looking at is a hypothetical client couple that I created out of thin air. Their names are Frank and Joanna Miller. And what we're looking at here is a projection of their lifetime portfolio assets based on what they have in their savings and investment accounts. And this is nothing elaborate. If we assume that their investments grow at about 7.5% per year, and we know exactly how much they're going to spend each year, and we know when they're going to retire, then we can make a reasonable projection on a year-to-year basis about what this might look like going forward. Now, this is not something we should have a whole lot of confidence in because they're not going to get 7.5% every single year from their investments. Some years the investment returns will be good. Other years investment returns will be very, very poor when there's a bear market. The whole point is understanding how these things play against each other. And as you can see for Frank and Joanna, they have some decisions to make. They're probably not ready to retire yet. So in this situation, what we've gone through is some different scenarios. And if they're able to sell their vacation house for $275,000 and by doing so reduce their maintenance and property taxes by another $15,000, and let's say that they agree to work another 3 years longer than they had initially planned to, well, now things are starting to look a little bit better for them. The next thing that we can do here is run a Monte Carlo analysis, which is 1,000 trials, knowing the probabilities that their investment assets might go up versus down versus sideways. And with these three variables toggled on, they're really in a pretty good position. 81% chance of success is a very strong position to be in. Now, the whole thing for Frank and Joanna is, along with this retirement evaluation, they need to make a decision surrounding whether to pick up a long-term care policy or not. And so what we should do here is take a look at what their portfolio value might be. Again, we're making a lot of assumptions here. We can't trust this in full. But if they incur substantial long-term care costs starting at age 85 respectively, and what I used there was $100,000 per year, which is somewhere in line with the national average if you need to go live in an assisted living facility. And each of them incur those costs for 5 years. How does that impact their financial picture? Well, you can see that all of a sudden things don't look so good. So from their perspective, if we go back to this Monte Carlo analysis, their plan has changed drastically and their probability of success has fallen from 81% to 46%. So that might mean that in order to self-insure, they need to do something else, like get $350,000 for the vacation house. Let's see what that does. It runs 1,000 trials, which takes just a minute. Doesn't make that big of a difference. So in this situation, I would say that Frank and Joanna are, on the face of it, potentially good candidates for long-term care insurance because they don't have the capacity to self-insure, but they do have substantial assets that they could use to pay for a policy in the first place. Now, realistically, what happens is when people get into their 80s and they make the decision that they need help, if they have home equity, many people moving into an assisted living facility or obtaining long-term care services will decide to use the home equity that they've built up over the years toward those expenses. Either you can sell your house and take the cash and you have cash to buy into one of these places or use to offset costs, or you can take out a reverse mortgage. It's not the worst thing in the world to do. Years ago, they were very predatory. These days, they're not quite as bad. But this is an example and a case study of a client couple who should probably at least consider and get some pricing on a long-term care insurance policy. So here's another scenario of a different couple I created out of thin air named John and Jill Denver. You'll notice that their situation is surprisingly similar to Frank and Joanna. They're going through a lot of the same decisions. They have to make a lot of the same decisions about when they retire and what happens afterward. So in this case, John and Jill are both expecting to retire at 65 respectively, which happens in 2032 and 2033. And by the looks of our retirement portfolio projection, they're starting off on a pretty strong footing. And if we review their Monte Carlo analysis, they have an 83% chance of success right off the bat before incorporating any long-term care costs. Now, as I mentioned a moment ago, we cannot fully trust these methods of analysis because we're giving the program a whole bunch of information. We're telling this program to make a whole bunch of assumptions, and then we're telling the program that those assumptions are going to remain true indefinitely. And realistically, that's just not how life works. Things are going to change more and more over time. Nevertheless, this is a very helpful data point. So what we should now look at is what happens if John and Jill both incur $100,000 per year assisted living costs or long-term care costs, however you want to put it, when they both hit 85. You can see that puts a big dent in their expected asset levels down the road. And it impacts their Monte Carlo accordingly. Again, it takes a moment to run 1,000 trials right on the fly here. All the way down to 57%. So for John and Jill, if they are dead set on retiring at 65, they're not going to retire any longer than that. They're not comfortable selling the vacation house or doing anything else, pulling any other strings, then they could potentially be a pretty good candidate for long-term care insurance. But if they're comfortable selling the vacation house and they can get $275,000 for it, which reduces their property tax and maintenance expenses on a year-to-year basis, or if they're comfortable and in this situation, and they're comfortable retiring a few years later, 3 years in fact, then that brings their chances of success way, way up, even if they incur substantial long-term care costs down the road. So what I would say is that for John and Jill, if you don't mind selling the vacation house and you don't mind working a few more years, there's no need for long-term care insurance at this point. But if you really want to retire at 65 and you want to hang on to the vacation home, then maybe we might want to pay an insurance company to take some of that risk for you. So those are two separate scenarios, two separate case studies where it may make sense to incorporate a policy. It may not make sense to incorporate a policy in the second one. As always, it depends on pricing. It depends on the cost of transferring. How much is it going to cost you to transfer that risk to the insurance company? And you may or may not want to pull the trigger when you figure out what the premiums are for yourself. I hope you liked today's video. If you did, make sure to hit the like button at the bottom of the screen and subscribe to the channel to make sure that you're notified anytime we come out with something new. On top of that, if you're not sure whether you're on track financially, you might want to check out our free wealth gauge assessment. There's a link for it in the comments. Basically, you click the link, you take 3 minutes to fill out some basic financial information about yourself. We take that information and run it through our financial planning software. Then we send you via email a short private video of our findings and 30,000-foot observations.